Send it to the moon. Get those diamond hands. Hold the line, fellow audits. YOLO. This has been the discourse reverberating throughout subreddit r/Wall Street Bets for the past 2 weeks. Marquette University business journalism professor Jim Nelson and senior in the College of Business Administration Joe Vetrano explain the development.
So these are individual traders like you and I. They've been banding together and they've been discussing where to invest.
The idea behind these moves was to perform a short squeeze. So these companies like AMC, GameStop were all essentially viewed by investors as kind of bad companies. And for good reason, let's be real. AMC could go bankrupt. I mean, they're a theater company in the middle of COVID-19. GameStop is a brick and mortar game sales when people are going to download their games in the future. So the idea here is that a lot of these investors are shorting them, which means essentially to borrow shares and sell them in the hopes that the price goes down. When you borrow the shares, and if everyone buys up those shares around them, well, eventually they have to buy back. They have to cover, it's called covering your position. But if everyone else owns the shares, they can kind of mess with you. You can kind of get bullied. So that's kind of what was happening with GameStop. Everyone is shorting, but then whenever all the shares are absorbed, essentially, they can sell it to the hedge funds for whatever price they want.
The GameStop short squeeze, or GameStonk as it is called in internet circles, is one of the first of its kind.
It's like a very interesting thing because I can't think of something like this happening in the market.
Marquette University economics professor Stephen Cole gives his perspective on the situation.
It seemed like these individual investors did so more because of they wanted to, I guess, go against the institutional investors.
For reference, it is helpful to look at extremes. Cole discusses the infamous 2008 housing market crash.
There's always instances of, stocks shooting above maybe their fundamental price or shooting below their fundamental price based off irrational things like back before the 2008 2009 crisis. Housing just kind of soared up, just mainly based on people's expectations. Everyone thinks it's going up, so why not buy it? And so I don't see too many big repercussion effects unless this sort of thing continues with other stocks and everything. So yeah, I think right now it's just kind of a wait and see, see what will happen with this, if this is just a one-off thing or if there will be a potential kind of game changer thing going on in the market.
A big part of this uncertainty is connected to the unfolding online discourse, because private investors can exchange information that the funds legally cannot.
It's a little bit unprecedented in that there's this online discourse that's kind of something new in the financial market.
This fluctuation, says adjunct business journalism professor Jim Nelson, may have been due to happen.
I would just say that this is one of these disruption times for a part of our economy, of the investing world, the Wall Street world. That big world has a lot of aspects to it, and some of the internal workings of it are kind of due for disruption.
And with many economic factors, there are political influences which bleed into the market and the mindsets of those who participate in it.
I mean, especially too with, the recent election, in our political environment right now, it's very partisan, very all these emotions going on. So, maybe once this election, since it's over, maybe things will start kind of cooling down, and maybe that'll also have a ripple effect on this kind of stock market stuff.
The activity on Wall Street has hit close to home, even closer than GameStop. The effects of the short squeeze movement, Nelson said, even extended to Koss, the family-owned Milwaukee headphone company.
Koss Corporation, based in Milwaukee, got caught up in this. An over-the-ear headphone maker. Think about the last time you wore or bought a Koss headphones or earbuds product. I guarantee, I bet you never have. Largely owned by the family. Most of the stock was owned by the family or the officers of the company, like 80%. So this is a very small amount of stock, but At one point last week, the stock price hit $100 or so from $2 or $3. The family members collectively turned in their shares, redeemed their shares, and they cleared like $30 million. That's more than the company was worth at, 3-4 weeks ago.
But while enthusiasm was booming, some lost big time.
Those shares have kind of returned to planet Earth, just like cost has. Still higher, but they've come down. For a lot of people made money here. There are people who blew it.
The GameStop short squeeze has not gone unnoticed by Marquette students, at least not by the Applied Investment Management program's Joe Vetrano. Vetrano had been following the story closely, and he had some thoughts on it.
I think overall for Marquette students, it's kind of exciting. It's interesting. It brings a lot of attention to the stock market, which I think can be a positive thing because a lot of people in the U.S. around the world don't invest, and as I've come to learn, obviously studying it, it's a great opportunity to grow your wealth and to make sure you're financially stable in the future. It's an important part of our economy.
But this economic importance brings with it a lot of responsibility. Responsibility which could have profound effects on one's well-being.
I'm in the AIM program, which is an Applied Investment Management program. Specifically, I'm studying finance and economics. So as a part of the AIM program, we sort of study stocks. I think anyone who says they study stocks, doesn't exactly understand why everything happens.
It becomes easy to forget the emotional side of finance, Vetrano said, and there are a lot of misconceptions floating around that could put investors at risk.
I think my general impression is, though, that our people are getting a lot of misinformation about it. People are making a lot of judgment calls when they don't exactly know what's going on.
Vetrano gives his opinion on the Redditors.
Some people feel like the Wall Street Bets people or the Redditors were in the wrong because they were kind of posting these things. They were making these claims about how amazing the company is. And so that's one take. And then the other sort of view is that, well, hey, look, these are the little guys. They're making lots of money off these hedge funds. This is great. This is awesome. I mean, this is really cool. This is really interesting. So I think it's a little bit nuanced, more nuanced than both of those. Maybe it kind of began as like an intelligent investment in GameStop because some important events happened. There was a new active investor who worked with the company Chewy. He invested, I believe, like 10%. That sort of helped the stock. But I think kind of what happened was people started to get some gains on the stock and more people were kind of excited about that. And they invested more. And so some of the people in the early sort of stages really were happy with how things were going, but then maybe it got a little bit out of hand.
Fueling this populist movement and the continued slanted discourse, Vetrano said, was the bias many people hold against hedge funds.
I think that people have been thinking of hedge funds wrong in the sense. People kind of think of them as the evil guys. And, not to say that there aren't evil hedge funds, that's for sure. But I think there's this broad brush painted on them. People forget that a lot of hedge funds are invested by pension funds. And that could be teachers, firefighters, or schools, for instance, right? So I mean, you can imagine if a hedge fund blows up and there's a bunch of pension money in it, that means that somebody's not going to get their money when they retire. I mean, that could be the make or break. And I'm not saying that, Melvin Capital were these like, white knights or something, but it's a good reminder about the risks for sure. I mean, whether you're buying or selling, I mean, if you bought in late to GameStop, you'll find that you might have been really crushed.
Vetrano reflected on the people who blew it.
I've heard some really sad posts too, where people are saying that they had a gambling addiction and this brought them back to gambling and they lost lots of money. Will this have greater effects on the market? Maybe. So back to the Reddit aspect of it, maybe in the future there'll be other calls like this where people say we like another stock and hey, it'll soar for a bit. But in terms of investing styles, a lot of funds don't like to get involved in this because, as you can see, it's easy to get burned.
On whether the market will remember the GameStonk, Stephen Cole had this to say.
So it's hard to say, but I would think like in the near future, probably the expectation is that more of the market norm would persist and these kind of I don't know what you call it, but these kind of, big fluctuations, maybe unexpected fluctuations in stock price like that. It's just a really complicated issue.
This is all kind of very emotional. People kind of forget the emotional aspect of investing, seeing your account go up or go down. And so if you want to treat it like that, I mean, then you have the ability to, but that is extremely risky and you could lose all of your money. And I think that the stock market is not meant for that. It's meant for investing, and it's a great tool to build wealth. It's an important tool for things like pension funds that help fund people when they retire. Using this tool responsibly is what it's meant for.
Reporting from Milwaukee, I'm R.E. Hagan, Marquette Wire Arts and Entertainment.